Joining me now is 42 Macro founder and CEO Darius. Darius, great to see you.
It's great to see you. Thanks for having me.
Thank you so much for being here. So what is your reaction to a 50 basis point cut from the Federal Reserve? And this, the put is in. Markets have been rallying ever since.
Yeah, absolutely. And we've been making that call since November of last year, is that this Fed has an asymmetrically dovish reaction function that wants to engineer a soft landing in the economy, and they're going to get it.
You think it'll be a soft landing?
We have a lot of belief in that, at least with respect to the next 12-month forecast horizon. Once you get into the second half of 2025 and into the first half of 2026, all bets are off. If the Fed still has a restrictive policy setting by then we could slide into recession. But between now and then, I think a soft landing is the highest probability outcome.
Mark Tepper, weigh in here, because we've seen lots of cracks in the labor market as well as the consumer, right?
Yes, certainly. I mean, when it comes to the consumer, you were talking about $1.1 trillion in credit card debt. There's an estimated $700 billion in buy now, pay later debt, which nobody really knows about because it's not reported to the credit bureaus. The number of multiple job holders are at an all-time high. And probably the number one thing that I'm concerned about right now, Darius, is the fact that the market right now for 2025 is pricing in 15% earnings growth, which is very, very tough to hit. Normally, when the Fed cuts by at least 100 basis points, it's very rare that you see even low double-digit earnings growth. Do you think that's potentially setting up the stock market for disappointment as we enter next year?
Yes, I think it's from a fundamental standpoint, you could be set up for disappointment, but I think the ultimate driver of what's happening here is the rapid growth of liquidity. We have obviously liquidity coming in from China, $300 to $400 billion we estimate over the next 6 to 12 months. And then we also have, if we start at the beginning of next year, the debt ceiling moratorium lapses. And you're talking about roughly $700 billion of TGA spend down in the first 3 to 4 months of next year. So you don't want to fight that as a bear. I think you want to pause the bear case and revisit that maybe Q2 of next year.
Yeah, you got two things going on right now. You've got the optimism over the Federal Reserve lowering interest rates. By the way, Chairman Jay Powell is going to speak on inflation later today. So maybe that's part of this rally going into the Fed's speech. But then there's China. Okay, so overnight they're announcing that they are injecting $142 billion of capital into the top banks. They've been trying to, use stimulus to offset what has been a very weakened economy in China. Is that what this is about? The fact that markets are higher across the globe and we've got this rally underway. Is this because of China injecting capital? Well,
it's a confluence of things, but certainly China injecting capital is one of those things. I mean, what happened over the last few weeks is that the rest of the world took its cues from the Fed to start injecting liquidity to save their economies and save their asset markets. And that's ultimately going to be fungible across global financial markets. And we do have a very sanguine take on where global financial markets are headed over the next, let's call it 3 to 4 months, as a function of that and as a function of the economy remaining resilient. And one final thing I'll say is with respect to the credit debt, that is certainly an issue, and certainly for small businesses and low-income consumers. But when you think about the U.S. economy, it's a very K-shaped, top-heavy economy. And if you have stocks railing to all-time highs and valuations, remaining robust, you're going to continue to have a consumer that spends.
Todd.
I've been on this show now for a couple of years, and most of the time we talk about decoupling from China. If the world economy just got this sugar high from this investment of capital by China, is there going to be any decoupling specifically in the U.S. anytime soon?
No, I don't think that you certainly can't decouple from a financial standpoint. You can decouple from a trade standpoint, and we're likely to continue to see trade protectionism rise throughout the course of this decade. But as an investor, it's our job to figure out where the markets are going. And ultimately, we believe the actions that the PBOC and Beijing are taking currently are likely to perpetuate a softer economic outcome, a better economic outcome relative to the consensus, which is calling for, some pockets of consensus are calling for recession, other pockets are calling for a significant and sharp deceleration in growth. We see neither of those outcomes as probable.
You have started your own firm and you're focused on the macro story. Nancy Lazar is a regular guest on this program as well.
Respect for Nancy.
Yes,
awesome.
She's been doing great work on the macro side. So I want to get your take on what she says on the macro story. She was with me this week. Watch this.
Today, we would say we have the stay-at-home bubble bursting, which is why you have such bifurcation within companies, particularly on the consumer, but also on the industrial side. We have way too much consumer installment debt. Thank gosh, it's not a mortgage debt problem today, but it is a credit card problem, and you have a clear increase in delinquency rates. And then last, we also have a very sharp increase in auto inventories. The IS ratio has increased dramatically. So we have these economic excesses, which also help determine the length and depth of the recession, along with what the Fed does, how quickly they indeed ease. So our base case is good news: the Fed's cutting rates, but it's too late.
So she says it's too late and we are going to see a recession in 25. Your reaction?
Yeah, I mean, we just disagree. I mean, if you look at the principal leading indicators of the business cycle in terms of how the process works, first you have policy tighten, then you have liquidity drain, then you have growth slow, then you have the markets break down, then you finally have the employment picture breaking down. We don't have those preconditions right now that would suggest a recession is a high probability event over medium-term time horizon. So in order to actually have a recession, you would actually need something that you can't forecast, a black swan, and we're not obviously forecasting that. We're actually forecasting things to resolve quite sanguine.
Well, the liquidity part of the story is real. $6 trillion in money market accounts on the sidelines. You think that it ultimately finds a home in stocks?
Oh, yeah. Well, to me, the big pocket of liquidity out there that no one's talking about, but they will be if markets are much higher 4 to 5 months from now, is the roughly $700 billion in the Treasury General account. They're going to have to spend that down once the debt ceiling moratorium lapses on January 1st. Okay. And recall the last couple of times they spent that down, we had raging bull markets in stocks in 2021 and 2023.
All right, we'll leave it there. Darius, great info from you. We so appreciate your time.
Appreciate you. Thank you, Maria.
Thank you so much. Darius Dale's running us here.